Steve, it's good to see you. And is this, I will repeat the question, a buying opportunity for tech?
Well, Kelly, in some sense it has to be because we've become extremely oversold. That's true of most groups, of course. And it's very similar in tech to late 15, late 18. So you have to be thinking more buy than sell here. But at the same time, we think that there are going to be rallies like today. You probably want to fade those rallies. It's still too early to call an all clear. One thing that I like, though, is that you mentioned the XLK, and we've all talked about tech outperforming the last year, but it's been very narrow. The XLK is very heavy in Microsoft and Apple and Visa and MasterCard. Our index, which is equally weighted, has been a market performer. But what I like is that our equal weighted index has started to outperform the last couple of weeks. So hopefully it's not just going to be about large cap when we come out of this.
Would that be your advice for investors as well, to look beyond the names that used to be in the $1 trillion market cap club? I think Microsoft's still up there.
It is. I mean, we still like those names. First of all, in the short term, we would still be defensive. And that tends to mean the names that have been outperforming on the way down. It's large cap. It's a lot of the stay-at-home names, Citrix, Zoom, Spotify, Amazon. But coming out of this, and we're not there yet, but coming out of this, we'd be interested in adding to semis, services. Those stocks have really been hurt. And then probably going down cap. Maybe not all the way to the smallest market cap, but some small and mid-cap names I would expect to rebound and maybe give you a little extra juice on the upside.
And what about hardware and the case for those plays?
Hardware I view as a trading group. It's a group I used to cover. It's a combination of traditional systems companies like Cisco and so forth. I think when we come out of this and the PMIs start to improve, investors get confidence in the economy, those are going to be great trades, but they've got secular wind in their face. The other part of hardware is the supply chain. The supply chain acts a little bit more like semis, names like Amphenol, Flex, Jabil. And some of those names, I think, could be buy and own when we come out of this.
So then finally, since we've outlined a number of places where you do see opportunity, what would you tell people to be most wary of here?
We put together a little list of high dividend yield stocks. I'd like to think at some point those provide some real yield with interest rates so low. They're not outperforming yet. We would certainly avoid names with high debt. Companies with net debt to EBITDA ratios over 3 are underperforming. In tech, you generally don't want to add financial leverage to operating leverage. So names like Dell, even IBM added a lot of debt with the Red Hat acquisition. So we'd be careful there. Normally, we'd be saying, watch out for these really high multiple software stocks. The fact is that they're outperforming right now. So you have to be picky, but I wouldn't necessarily be scared off by those high price to sales ratios.
All right, Steve, it's good to hear from you again today. A lot of different names across the entire tech sector there. Appreciate it, sir. Thank you very much.
Thank you, Kelly.